I need you to pay very close attention to what I'm about to share with you because I've seen this movie before. Gold is moving right now in a pattern that I have witnessed only a handful of times in my career. And every single time this pattern has emerged, it has preceded a major financial crisis. The way gold has been trading over the past several months is sending a warning signal that most investors are completely ignoring. They're watching the stock market make new highs. They're listening to the Federal Reserve talk about soft landings. They're celebrating the supposed strength of the economy, but gold is telling a completely different story. Gold is the canary in the coal mine, and right now, that canary is screaming at the top of its lungs. If you understand what I'm about to explain, you will see exactly why this moment in history is so critical for your financial future. Let me take you back to 2006 and 2007. During those years, gold began a steady, persistent climb that Wall Street largely dismissed. The stock market was booming. Real estate was soaring. Everyone thought the good times would never end. But gold saw something different. Gold saw the cracks forming beneath the surface, the subprime mortgage crisis that was brewing, the leverage building throughout the financial system, the house of cards that the Federal Reserve and Wall Street had constructed together. Gold climbed from around $500 per ounce to over $800 before the 2008 crash. And when that crash came, gold didn't just hold its value, it exploded higher while everything else collapsed. By 2011, gold had reached over $1,900 per ounce. The people who read the warning signs that gold was sending became wealthy. Everyone else got devastated. Today, I am seeing the exact same pattern. Gold has broken out of a multi-year consolidation in a way that mirrors what happened before 2008. It has pushed through resistance levels that held for years. It has done so despite the Federal Reserve raising interest rates, which traditionally puts pressure on gold. This divergence is enormously significant. When gold rises in the face of headwinds that should be pushing it lower, it tells you that smart money sees something terrible coming. It tells you that institutional investors, sovereign wealth funds, and central banks are positioning for a crisis that most retail investors haven't even contemplated. Small investors must watch this pattern carefully because it is a roadmap of what's coming. You need to understand why gold moves like this before crises. Gold is not just another asset, it is the ultimate form of money, a store of value that has preserved wealth for 5,000 years of human history. When sophisticated investors become genuinely worried about the stability of the financial system, they don't flee to bonds, they don't hide in cash, they accumulate gold because gold has no counterparty risk. It cannot go bankrupt. It cannot be printed into oblivion by a central bank. It cannot be defaulted upon. When you see gold moving persistently higher despite conditions that should theoretically suppress it, you are watching big money prepare for something serious. The parallels to the pre-2008 environment are striking. Back then, we had a massive debt bubble in housing. Today, we have a massive debt bubble in everything. Government debt, corporate debt, consumer debt, student loan debt, auto loan debt. The total debt levels today dwarf what existed in 2007. The federal government alone is running deficits of nearly $2 trillion per year, adding to a national debt that has exploded past $35 trillion. This is not sustainable. Everyone knows it's not sustainable, and gold's price action is reflecting that reality. The market may be in denial, but gold is not fooled. Let me explain what I see in the current gold chart because the technical picture is remarkable. Gold spent nearly 4 years consolidating between roughly $1,800 and $2,000 per ounce. This was a period of accumulation. Smart money was quietly building positions while the financial media ignored gold entirely. Then, in late 2023 and into 2024, gold broke out decisively. It didn't just poke above resistance, it surged through it with conviction. This breakout pattern is identical to what we saw in 2005 and 2006 before gold began its historic run to $1,900. The base that has formed is even larger than the one that preceded the 2008 crisis, which suggests the coming move could be even more powerful. The fundamental backdrop supporting this move is even more compelling than the technicals. Central banks around the world have been buying gold at a pace not seen in decades. China, Russia, India, Turkey, Poland, Singapore, nation after nation is adding to their gold reserves while quietly reducing their exposure to U.S. Treasury bonds. This is not coincidence. This is a coordinated move away from the dollar-based financial system. These countries see what's coming. They understand that the United States cannot continue to finance its deficits without eventually resorting to money printing on a scale that will destroy the dollar's purchasing power. They are protecting themselves. The question is, are you? The Federal Reserve is trapped in a position from which there is no easy escape. They raised interest rates aggressively to fight inflation, but they haven't actually defeated inflation. They've merely suppressed it temporarily while creating new problems. The higher rates have stressed the banking system, as we saw with Silicon Valley Bank and the regional banking crisis. They have made the federal government's interest expense explode to over $1 trillion per year. They have pushed commercial real estate to the brink of a crisis that could rival the subprime collapse. Something is going to break. It always does when conditions become this stretched. And when it breaks, the Fed will have no choice but to reverse course and start cutting rates and printing money again. This is exactly what gold is anticipating. Gold knows that the Fed's inflation fight is a temporary phenomenon. Gold knows that when the next crisis hits, whether it's a banking crisis, a sovereign debt crisis, a commercial real estate collapse, or something else entirely, and the Fed will respond the only way it knows how, with massive money printing. And that money printing will send gold to levels that most people currently consider impossible. We're not talking about $3,000 per ounce. We're talking about $5,000, potentially $10,000 per ounce when measured in increasingly worthless dollars. I want to address those of you who are watching gold's recent rise and thinking you've missed the move. You haven't missed anything. If my analysis is correct, and the weight of evidence strongly suggests it is, we are in the early stages of a gold bull market that could last for years. The move from $2,000 to $2,400 is just the beginning. In percentage terms, gold has not even matched the gains it made during the 2000s bull market, let alone the explosive move of the 1970s when gold rose over 2,000%. The biggest gains are still ahead, but they will only benefit those who have the foresight to position themselves before the crisis fully manifests. Consider what happened in the 1970s because the parallels to today are uncanny. That decade began with the U.S. abandoning the gold standard, which allowed the government to print money without constraint. Inflation surged. The economy experienced stagflation. High inflation combined with slow growth. The stock market went nowhere in real terms for the entire decade, but gold went from $35 per ounce in 1971 to $850 by 1980, a gain of more than 2,000%. Those who owned gold preserved and multiplied their wealth while everyone else watched their purchasing power evaporate. We are setting up for a repeat of that scenario, potentially on an even larger scale. The inflation that emerged in 2021 and 2022 was not transitory. No matter what the Federal Reserve claimed, they were wrong then, and they're wrong now in believing they've solved the problem. Inflation is embedded in the system because the fundamental causes of inflation, excessive money printing and unsustainable government spending, have not been addressed. They've been papered over temporarily with higher interest rates that are themselves creating new crises. When the Fed is forced to cut rates and resume quantitative easing, inflation will return with a vengeance. Gold is the only reliable protection against this outcome. If you see what I see, you understand that the current financial system is living on borrowed time. The debt levels are too high. The deficits are too large. The political will to address these problems does not exist. Both parties in Washington are committed to spending programs they cannot afford, funded by borrowing they cannot sustain, which will ultimately require money printing that will devastate the purchasing power of the dollar. This is not a partisan observation. It's simple mathematics. And gold's price action is confirming that the smart money agrees with this assessment. The top 0.1% of investors, the family offices, the billionaires, the sophisticated allocators, have been quietly increasing their gold exposure for years. They don't advertise these moves. They don't appear on CNBC to discuss their gold positions. But if you look at the data, you can see what they're doing. Gold demand has been persistently strong despite minimal retail interest. That demand is coming from somewhere, and it's coming from the people who have the most to protect and the best information about what's coming. These are not people who panic buy after a crisis has already begun. They position ahead of time. And right now, they are positioned heavily in gold. For small investors watching this, the opportunity is extraordinary. Gold remains accessible. You can still buy physical gold at reasonable premiums. You can still purchase shares of quality gold mining companies at valuations that don't reflect what's coming. You can still establish positions before the crisis that gold is warning about actually arrives. This window will not remain open indefinitely. When the next 2008 style event occurs and gold's price action is screaming that such an event is coming, the rush into gold will be overwhelming. Premiums will spike. Availability will become constrained. Mining stocks will gap higher before you can act. The time to prepare is now, while most investors remain complacent. I want to emphasize something critical about gold's role in your portfolio. Gold is not a speculation. Gold is not a trade. Gold is insurance against the failure of the monetary system that underpins all other financial assets. When you buy gold, you're not betting that gold will go up. You're protecting yourself against the very real possibility that the dollar will go down. You're hedging against the scenario where the stock market crashes, the bond market crashes, the banking system becomes unstable, and the Federal Reserve responds by destroying the currency to keep everything afloat. This scenario is not hypothetical. It's exactly what happened during the last crisis, and the conditions today are even more extreme. The behavioral aspect of this situation frustrates me enormously. Most investors have been conditioned to ignore gold. They've been told that gold is a barbarous relic, that it pays no yield, that it doesn't perform as well as stocks over time. These arguments miss the point entirely. Gold is not supposed to compete with stocks during normal times. Gold is supposed to protect you during abnormal times, and we are heading into profoundly abnormal times. The people who focus on gold's lack of yield while ignoring its wealth preservation characteristics are going to learn an expensive lesson when the next crisis arrives. Mining stocks deserve special attention in this environment because they offer leveraged exposure to gold's rise. When gold moves from $2,000 to $3,000 per ounce, the profit margins of gold miners expand dramatically. A company that makes $200 per ounce at $2,000 gold makes $700 per ounce at $2,500 gold. That's not a 50% increase in profitability. It's nearly a 400% increase. This leverage is why mining stocks can rise 500, even 1,000% during major gold bull markets. The miners today are trading at valuations that suggest the market doesn't believe gold will rise much further. When that perception changes, the revaluation will be swift and dramatic. The geopolitical dimension adds another layer of urgency to this warning. The world is fragmenting. The US dollar's role as the global reserve currency is being actively challenged by China, Russia, and their allies. The BRICS nations are working to create alternative payment systems that bypass the dollar entirely. The weaponization of the dollar through sanctions has accelerated the move away from dollar dependence. As global demand for dollars decreases, the United States will find it increasingly difficult to export its inflation to the rest of the world. That inflation will come home, and gold will be the primary beneficiary. I have been warning about these issues for years, and I have been criticized for being early. But being early is very different from being wrong. The fundamentals I've been highlighting, the debt, the deficits, the money printing, the dollar weakness, have only gotten worse over time. Gold's recent breakout is validation that the market is beginning to recognize what I've been saying all along. The question is not whether my warnings will prove correct. The question is whether you'll be positioned to benefit when they do. The next 12 to 24 months could be the most important period for gold in decades. The combination of extreme debt levels, a trapped Federal Reserve, geopolitical instability, and technical breakout conditions creates an environment where gold could move explosively higher. I'm not talking about gradual appreciation. I'm talking about moves that will make headlines, that will force the mainstream financial media to finally pay attention, that will create enormous wealth for those who are already positioned. This is the opportunity of a generation, and it is unfolding right now. Let me be clear about what I'm recommending. I believe every investor should have meaningful gold exposure, not 5% of their portfolio, but 20, 30, perhaps even 50% depending on their circumstances. This exposure should include physical gold in your possession, gold stored in secure allocated storage, and carefully selected gold mining stocks. This is not a trade to be made and abandoned. This is a strategic position to be built and held throughout the crisis that is coming. The people who build these positions today will be the ones who preserve and grow their wealth over the coming years. The warning that gold is sending right now is the most important signal in financial markets. It is telling you that something is profoundly wrong with the system, that a reckoning is approaching, that the time to prepare is running out. Most investors will ignore this warning just as they ignored the warnings before 2008. They will be caught off guard. They will panic. They will make emotional decisions that devastate their portfolios. But you don't have to be among them. If you've watched this far, you understand what's at stake. You see the pattern that's forming. You recognize the opportunity that exists. Gold is moving like it did before the last crisis because another crisis is coming. The only difference is that this one could be bigger, more disruptive, and more damaging than 2008. The debt levels are higher. The Fed's ammunition is more limited. The global order is more fragmented. The conditions for a perfect storm are forming, and gold's price action is the clearest warning we have. Don't ignore what the market is telling you. Act now while you still can, and position yourself on the right side of what's coming. The clock is ticking and gold is sounding the alarm. The question is whether you'll listen before it's too late.